Hey everyone, Evan Melcher. I'm going to spend some time going through the mortgage payment protection in home. This is something that honestly in the beginning for me was a very difficult sell. And the approach to it is different for sure, and people get tripped up on it because we see these older folks or we see people that are unhealthy, they can't get approved for the full mortgage protection, it throws us off. We backtrack, it doesn't work out. So what we're doing with the payment protection, so typically we're going to be with a client that is, anywhere from ages 60 to 85. And the way to go about the payment protection is we're not able to fully protect the $100,000 loan, okay? But if their mortgage payment is $600 a month, we're able to get them 1, 2, or 3 years worth of something we call payment protection for their mortgage, just so that if John passes, we lose his income. Mary, who's on a very strict Social Security income, isn't going to be able to handle the mortgage. She just isn't going to be able to. So what this does is this just buys Mary some time to sell and downsize, especially if they've been in the house for 30 years. They've got $100,000 worth of equity built up. We're protecting that. If we lose John's income, Mary can't swing it, and maybe the market isn't great at that time. If she can't sell the house, we don't want the bank taking it and getting all that equity that's built up. So there are a few key things. Again, with mortgage protection, I'm always breaking down the monthly payment. I'm breaking down their individual monthly income. I'm crossing out one, and perfect, there's the sale, that's why I'm here. The way we word some things in a situation like this is crucial. Now, Mary, I'm assuming, like most people, if something happens to John today, this is like a 3,000 square foot house, there's stairs, you would probably just sell and downsize like most people, right? Like this is just too much upkeep for you, is that right? And they're gonna say yes, basically. And okay, perfect. So what most people in your situation are gonna do is they're gonna put either 1, 2, or maybe even a 3-year payment protection, just so that you have time to do that. We don't want you running from the funeral home to the real estate office. And that's a crucial thing for a lot of these folks. They do need this protection, and whether it's a spouse, whether it's just a single, John's single, and if something happens to him, it's his kids that are picking up the pieces. Well, we're going to dig into into his kids. How many do you have? Where do they live? Okay, so they're gonna have to take time off of work. They're gonna have to fly into town. They're gonna have to get rid of all your crap that's in the house. Like, I know this isn't fun to think about or talk about, John, but it's gonna affect them financially. And I don't know their financial situation, and honestly, I don't really care. Well, I don't mean it like that. I care, but you should do this for them either way, because we don't want them having to go out of their pocket. They have their own lives, they have their own family, and we want to show them that we care about them even more by putting something like this in place, so they have that comfortability. They have time to process. We just lost our loved one, and we've been in this house for X amount of years. It's something that's buying time. So that is the mortgage payment protection, in my opinion. I don't think it's really that deep. Again, we're figuring out their income. We're figuring out why they need it. We're figuring out what it looks like without one or the other incomes, and we're just buying time. And I think as long as we approach it as far as this is what most people do in the situation, and as far as we just paint that picture of Mary's gonna sell and downsize anyways, it's very smooth sailing. And again, it's something that tripped me up very early on, and even still today, sometimes when we look at our form and they have a mortgage of $300,000 or $200,000, whatever, and we think we can't get them approved. Now, whether they're old, whether they're unhealthy and we can't get them approved for a full coverage term, we use this whole life payment protection. I just take their monthly payment, we multiply that by 12, 12 months of the year, pretty straight math. Again, I flunked out of college, so I'm not very good at math, but just pop my little calculator out, monthly payment times 12, that's their annual payment. I show them a 1 year, 2 year, and sometimes a 3. And in a perfect world, we want to do the 2 year. If that's too expensive, no worries, we'll just do a 1, just to at least give a full year. So that's my payment protection approach. I hope you guys learned something. Thanks.